Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, February 6th, and today's theme is simple. The market still loves the future. It just wants a budget and a timeline.
So the vibe is AI is amazing, but also please stop lighting cash on fire in the name of GPUs. I'm ready. My portfolio is currently in the bargaining stage of grief.
Story 1. Big tech took a hit, with reports saying over $1 trillion got wiped from tech stocks as fears of an AI bubble ignited a sell-off. The big question investors are asking is not, is AI real? It's, are the returns going to show up before the depreciation schedule does?
1 trillion is such a cartoon number. Like, that's not a dip. That's the market doing a trust fall and realizing nobody's behind it. Why now? What flipped?
Mechanically, it's about expectations. If investors think AI spending is going up faster than profits, they reprice the stocks, especially the ones priced for perfection. It's basically like renovating your kitchen. If the contractor keeps saying just one more upgrade, the house better sell for more or you're just collecting fancy receipts.
And Wall Street is like, cool quartz countertops, but where's my free cash flow? Also, if everybody is buying the same shovels, chips, data centers, at the same time, margins get spicy.
Exactly. The finance behind it. When capex ramps, near-term earnings can look worse even if long-term potential improves. Markets discount future cash flows, so if the future gets pushed out, the present value drops. Actionable takeaway? Listen for 2 phrases in guidance: time to monetize and capex discipline.
So if a company says, we're investing aggressively, I translate that as, your stock is about to do yoga, downward dog. What should normal people do with this besides panic refreshing their brokerage app?
3 practical moves. 1. Position sizing. Don't let one theme become your entire net worth. 2. Prefer businesses that can fund AI spend with operating cash, not financial engineering. 3. If you're a long-term index investor, remember tech drawdowns are part of the ride. Rebalance, don't rage quit.
Story 2 is basically the same movie, different sequel. Amazon shares fell as it joined big tech's AI spending spree, and investors got nervous. Amazon is the friend who says, I'm just going to browse, and then walks out with a full cart and a new personality.
Right. What happened? Headlines point to Amazon sinking as investors worried about the scale of AI investment plans. The simple finance, even if revenue grows, heavy spend can compress margins and reduce free cash flow, so the market marks down the stock until it sees payback.
So it's not Amazon is doomed, it's Amazon is expensive and impatient shareholders are hungry. What's the tell that this spending is smart versus just keeping up with the tech Joneses?
Look for unit economics. Do AI features raise price, reduce churn, or cut costs measurably? In cloud, watch utilization and pricing power. If management can connect capex to specific products and a timeline, think, this improves fulfillment efficiency, or this increases cloud attach rates. That's credibility.
Show me the spreadsheet, not the sci-fi trailer. Also, as a consumer, I'm watching for the sneaky part. Subscriptions and fees going up because the app now has AI.
India's Reserve Bank kept rates steady, holding the policy repo rate at 5.25%, while staying cautiously optimistic on growth and inflation. For households, this is a no sudden surprises decision, at least for now.
Okay, explain it like I'm deciding between a home loan and emotional peace. If the repo rate stays at 5.25%, what happens to EMIs and fixed deposits?
Repo is the benchmark rate that influences banks' funding costs. When it's unchanged, lending rates and deposit rates often stabilize, though banks can still adjust based on competition and liquidity. For borrowers, EMIs are less likely to jump immediately. For savers, FD rates may stop rising, but they can remain attractive if banks want deposits.
So status quo is basically your bank won't randomly jump scare you this month. And for investors, mutual funds, does a rate hold change anything?
For bond funds, stable policy can reduce rate volatility, but returns still depend on inflation and future expectations. For equity investors, a steady rate can support valuations because it lowers uncertainty. Actionable. Match your time horizon. Short-term goals lean toward high-quality cash and short duration. Long-term goals can tolerate equity risk, but diversify.
And now for the currency corner, where my vacation budget goes to get bullied. Goldman and Nomura reportedly see the pound sliding to a 3-year low against the euro because of UK political turmoil and rate cuts looming.
That's the setup. If markets expect UK rates to fall faster or uncertainty to rise, capital can move elsewhere, weakening the currency. Think of currencies like interest-bearing rent on money. If the rent looks like it's going down, fewer people want to hold it.
So for normal people, if you're in the UK, euro vacations get pricier, imports can cost more, and anything priced in euros feels like it just got a raise. For investors, international funds suddenly matter a lot more than vibes.
Quick wrap. We saw AI spending fears hit big tech valuations, Amazon slide on capex worries, and the RBI hold at 5.25%, a steadier backdrop for Indian borrowers and savers. And on FX, a weaker pound scenario reminds us that rates and politics can hit everyday purchasing power.
My personal takeaway, if a company says AI 12 times, I'm asking, cool, what's the margin? If a central bank says status quo, I'm asking, cool, what's the inflation path? And if a strategist says 3-year low, I'm asking, cool, do I prepay my hotel in euros?
If you want more episodes like this, subscribe and leave a quick review. It helps other listeners find the show. And if you're making a money decision this week, write down one number you'll track: free cash flow, your loan rate, or your currency exposure. One metric beats 10 hot takes.
Send this to the friend who thinks capex is a new energy drink. We'll be back tomorrow with another calm explanation of why the line went down, or up, depending on how dramatic the market feels.